Thursday, February 5th, the markets in New York are open, and our big number this morning, $16 billion. That is the amount pharma giant Pfizer is going to pay for Hospira, a maker of injectable drugs. Pfizer's bid of $90 a share is a whopping 39% premium to yesterday's closing price. Pfizer, rebuffed last year for its bid for AstraZeneca, is looking to grow its pipeline and is willing to pay for it. Hello, everyone. I'm Michelle Franzen in New York. Here with the details on all of this, Mike Santoli of Yahoo Finance. Hi, Mike.
Hi, Michelle.
Although not as large as the $120 billion bid for AstraZeneca, this is a big deal for Pfizer. Why does it need Hospira so badly?
Well, what it needs is a big portfolio of established medicines in a growing market, and that's what Hospira brings. And, you know, as you mentioned, they are largely what are called generic or biosimilar products, so they don't have patent protection. They're not more expensive branded medicines, but they are generic, cheaper, and that's obviously the way of the future. And that usually is a more stable business, so it definitely represents a shift from Pfizer's idea of doing that big deal with AstraZeneca in the so-called tax inversion that would have relocated the headquarters outside the U.S. for tax purposes. And this is really beefing up a part of Pfizer that already exists. And in fact, some people on Wall Street are already saying that they want to get that business, that kind of established drugs business, big enough to potentially separate it from the rest of Pfizer and do a breakup rather than a huge merger.
All right, so how big is the injectables and the so-called biosimilars industry within the main industry, and how big could it get in the near future?
Well, Pfizer, in its announcement, estimated that together they could be $90 billion in global revenue in 5 years, and obviously that's just a tremendous number. Right now, Pfizer's established business before the Hospira deal is somewhere in the realm of $25 billion in revenue, so it shows you they think that there's a pretty big opportunity here to take these products and sort of funnel them through the Pfizer sales and distribution platform. And, you know, it's interesting that Wall Street already likes the deal. Obviously, Hospira getting a very big premium, so that stock's surging. But also Pfizer shares in the pre-market after the deal was announced were up a couple or 3%, which shows you that people think this was a relatively wise use of Pfizer's money.
So losing patent protection, especially for money-minting drugs like Viagra, is that a deep concern for Pfizer and pharma other companies?
Yeah, in general it is. I mean, big pharma has been plagued by this for really a decade at least. They did a bunch of huge mergers. They were seeking out companies that had big blockbuster drugs. It used to be really this common thing that they would tout how many potential billion-dollar new drugs they had in the pipeline, but they really has not been a very productive pipeline in the last decade or so. You did have a lot of drugs come out for chronic treatments. That's been the big thing. So whether it's statins to reduce cholesterol, things like that, were always the bonanza. We haven't seen many of those, and therefore Pfizer's revenue has been stagnant for years right now. They've really occupied themselves with trying to cut costs, harvest cash flow, raise their dividends, and buy back stock, as opposed to put that money into the lab and try to find, the next blockbuster drug.
All right, let's talk a little bit about Hospira, the company that Pfizer is so interested in. You mentioned the history of this company, that it was once spun out from a big company about a decade ago.
Yeah, so Abbott Laboratories, which is another big pharmaceutical and medical products company, used to own this business. They kind of bundled a bunch of things together into something they called Hospira and spun it off to their shareholders in 2004. Stock did really well for a good long time. These spin-offs often do well. Management has new focus. They give them incentives to get the business in better shape. And often, actually, what happens is that same business gets passed on to another buyer who suddenly sees it as this jewel that's been developing out there. So, yeah, so it's kind of going back into the fold of big pharma, but at obviously a very big premium price.
So Pfizer had a lot of cash on hand, but it's not just that's also driving this. What about cheap debt that's fueling a lot of these deals?
That's been a constant story. Pfizer's a highly rated company. They have good cash flow, but they've been relying on some debt, both for this deal and just in general, to kind of do their stock buybacks and all the other things that these big established multinationals have been doing. In fact, one of the reasons it seemed a priority for Pfizer to do that AstraZeneca merger was because they have a lot of that cash stashed overseas. That would have given them access to it to fund their dividend and everything else. In the absence of that, they are left left with taking on cheap debt. And as we know, half the government bonds in the world right now yield below 1%, and highly rated companies like Pfizer don't have to pay that much more than that. So it's almost as if the world is giving them nearly free money right now.
All right, Mike Santoli from Yahoo Finance, thanks for joining us as always. And you, of course, can keep up with the latest headlines right here on abcnews.com. You've been watching The Big Number. I'm Michelle Franzen in New York.